Welcome to Innventuring, where we talk about what it actually takes to turn breakthrough technologies into companies with billion-dollar valuations. In each episode, I sit down with the innovation leaders, the investors, the operators, the experts who are building these companies in real time. This is Innventuring, the science of company creation. In our last episode, we talked about disruption, how breakthrough technologies reshape entire industries. Today, we're talking about something a little different. What it looks like when a company built to create those breakthroughs hits its own inflection point. If you've been following Innventure, you've seen the shift. For the first time in the company's history, every part of the platform is firing at once. Commercial bookings at scale, operating companies raising their own capital, and execution milestones landing across Excelsius, Aeroflex, and Refinity. This episode isn't about potential, it's about performance. It's about a platform transitioning from being capital funded to increasingly self-funding. And it's about what that means for investors, partners, and anyone trying to understand where the story goes next. To unpack that, I'm joined by two people who have had a front row seat to this entire transition. Innventure CEO Bill Haskell and Chief Growth Officer Roland Austrup. I'm your host, Chad Arnold, and this is Innventuring. Let's get into it. Good morning, guys. Well, Bill, I want to start with you. For listeners who've been watching the shift over the past few quarters, how do you describe what Innventure is becoming and the role it plays in this transition?
So first of all, Innventure is in the business of commercializing disruptive technologies that meet a certain need in the marketplace. And we acquire or license those technologies from multinationals with the goal of creating a commercial enterprise and scaling it to commercial scale to deliver that into the marketplace. But over the last couple of quarters, we've opted to fund our companies directly as opposed to from our own balance sheet until we get to the point where Innventure is generating cash flow organically. And we continue to control and provide those companies, and that we believe is really the lowest path risk to commercialization and is really friendly to shareholders.
Good. Roland, in the context of this inflection point that we're seeing with Innventure, how should listeners think about the cause-effect relationship between Innventure and its operating companies?
Great question. I mean, the cause is Innventure. The effect is the operating subsidiaries that we create. And I think that's an important distinction. I mean, when we went public with the tailwind of Excelsius, and that's the story that everybody has gravitated towards, justifiably so, because it's there's a critical need in the marketplace, and exactly as our model is supposed to do, we create companies to address those critical needs. And data center cooling for the next generation of chips is a significant need. But it's important for investors to understand that Excelsius only exists because Innventure exists. Innventure's model is, again, creating these disruptive companies. The first one, PureCycle, second one, Aeroflex, and the third one, Excelsius, fourth one, Refinity. It's important for people to understand that the cause of all of those businesses is Innventure, and the story is that process of creating companies like these businesses, not just one-off.
No, that's good. That's good. I think it's an important message for people to understand as we sort of look at the whole overall picture of Innventure and as we continue to create companies, what that relationship looks like. Bill, as Innventure moves from this shift from potential, we've been talking about potential for a long time, and we're moving to performance. I want to shift gears a little bit and talk about the structural mechanisms that have allowed Innventure to de-risk the companies we've created. What does that look like, and how is that done?
Yeah, really, Chad, it links back to our multinational partner relationships. So ultimately, we cheat in some way because the multinationals actually provide us with certain things that provide a de-risking framework. The first is that they have thousands of sales and marketing folks roaming the planet every day, listening to what the market needs. And so we know going into this that we're addressing a problem that is already known in the marketplace. Second thing is that these multinationals have often spent tens of millions of dollars in many years actually developing a technology that addresses that need. And while it's not fully baked, we know we're not taking any fundamental science risk. In other words, the development scale at the time that we acquire or license these technologies is such that we're not taking any fundamental science risk. It would only be, something that needs to be scaled up to commercial scale. The next thing is that the multinationals, knowing what the market needs, can also become a channel to the market, either as a direct customer or can provide a solution to their customers based upon the relationship they hold. And that's a really big advantage for us, because if you take a disruptive technology and insert that into the market, first of all, it's a little tricky to do that because you're changing the way the market operates.
Yeah.
But the horsepower that a multinational provides is very, very significant, above and beyond what a startup could do. Then of course we provide the capital and we provide the team to go address this. So we're never banking on first-time entrepreneurs. We're actually using our own people to create this company from scratch and then growing it up to commercial scale.
That's good. Roland, this quarter showed the system running across all three companies at once, which is super exciting. Walk us through where each company is as it relates to repeatability.
Sure, that's a great issue that to sort of address for our investors and shareholders, because every company goes through an arc from being created and seeded. You might have a pre-A round and an A round and a B round, C round, and whatnot. So there's a natural arc to every business that correlates to the funding arc. So maybe I'll just talk about the funding arc and where we are in each company.
Yeah.
If we look at Excelsius or frankly, we could go backwards and look at PureCycle, because PureCycle has a playbook that we're using again and again. In the case of PureCycle, we funded the business, we did an A round, then we did to fund OpEx, then we did a B round to create the feedstock evaluation unit. Once we were able to prove scale up and get commercial traction, we had a late stage, kind of pre-public round, and then we monetized and took PureCycle public. That's a good example of the arc of a business. So if we look at Excelsius today, we've now we did the same thing. We did an initial convert round, then we did a Series A to fund OpEx. We had a little bit of a bridge round, but effectively went into the $65 million Series B, which was a strategic round, not a financial round. It was a strategic round to bring in Johnson Control and Legrand as strategic investors. But now, because of that, Excelsius is at a much higher spot in its arc. It is now self-funding, cash on hand to reach cash flow break even. And that arc, I would say, is complete, because they now have a path where they see that they can become cash flow positive with the funding that they have on hand. Aeroflex, packaging has a longer cycle, so it went through the same things. We've done A and B rounds in Aeroflex, but now Aeroflex is in what I would call a C stage, or that would be called like a late stage VC or growth equity phase, because it's now going from 7 quarters of sort of piecemeal revenue to real volume production agreements with customers like Aveda. So I would say that if you look at Aeroflex, it's in that C phase, and it's capable of being funded on its own balance sheet. Refinity obviously is entering into an A round. So again, much like the PureCycle model, what we've done in Refinity is we've demonstrated pilot scale proof of concept. We've been able to take Refinity, produce its first metric ton of waste, and so it's now ready for initiating financing on its own balance sheet. So whether that's a convert or jump right into an A, typically where you look at in their arc is you're now going into their early stages, much like PureCycle was when we were looking to raise capital and build towards the feedstock evaluation unit. Right now, we're trying to fund Refinity up at an early stage, A stage, with the idea, as we've already announced, building the first 10 kiloton per annum plant.
Okay, that's good. Bill, sort of following up on that, and Roland's alluded to this a little bit. In the last earnings call, it was made pretty clear that there's a different cost structure, right? Not different, but it's shifted a little bit. In your mind, what are investors still holding on to that they're still anchoring to that no longer reflects the business of Innventure?
Yeah, sure, Chad. So, as you may know, when you take a company public, a lot of the reporting requirements change. A lot of the both governance and financial metrics have to change. And so, in order to jump onto a NASDAQ listed company and be compliant, we chose the path of hiring a lot of outside experts to help us become compliant, because you need to do that effective immediately once you're public. So we've been public for about 18 months, but there were a lot of one-time costs associated with doing that, putting all the capital required not only to get listed, because there's a lot of expense associated with it, both legal and financial, but once you're listed, again, all the reporting requirements and compliance requirements are substantial. So initially, we hired professional outside firms to assist us in that area. We've now migrated to bringing a lot of that functionality in-house, and the results are pretty clear. If you compare the fourth quarter of 24, which was our first public company quarter, with the fourth quarter of 2025, our SG&A was down over 61%, and in terms of actual dollars, it went from just under 13 million a quarter down to about 5.7 million a quarter. So very substantial. And those are permanent cuts, permanent adjustments that have been made. So extrapolating from what happened in the first year of going public, going forward, I think is a mistake. We had to raise a lot of capital, both to retire some existing debt and to pay a lot of those one-time costs. But those are behind us now. Those are history. And so on a go-forward basis, what you saw in the last quarter of 2025 is representative of what you could expect going forward. And we're making even further adjustments to continue to be good stewards of the company's capital.
Great. Yeah. Roland, do you want to add anything to that, or?
Well, I think the important part is what I mentioned earlier, and what I think Bill and I both kind of touched on. We're also moving to a model where we're funding our operating companies off of their balance sheets. So last year, we were, in addition to those one-time costs, we were funding all of our operating businesses off of the Innventure balance sheet through intercompany loans to underlying businesses. But it does take up a lot of cash flow, and a lot of cash money we had to raise was used towards that. So the degree to which we shift our funding model will also reduce the needs at Topco. The Innventure level.
Yeah, good. I want to follow up, Roland. You're out there talking to investors all the time. It seems, and maybe this is shifting, but I just want to throw this out to you and have you respond to it. It seems like the market mostly is seeing Innventure through the lens of Excelsius alone, right? Walk listeners through what else is happening across the rest of the platform that isn't reflected in the share price. Things that they're getting for free, right? Essentially, on top of Excelsius. Can you opine on that a little bit?
Sure, I can. And again, as I said in the opening, it's justifiable that investors are excited about Excelsius because we're excited about Excelsius. It's addressing. I mean, it hits everything about the Innventure model. Most importantly, it's not just an economic benefit. This is a critical need for one of the biggest growth trends in the marketplace, which is that convergence of high-performance compute and AI. So Excelsius is a critical need. It's justifiable that investors are focused on it. They see a company that has sort of hit all KPIs along the way, and that is at the forefront of two-phase cooling for data centers. And in fact, the proof point of that was Johnson Control and Legrand's investment, because they valued the pre-money valuation of their investment was $600 million last year when JCI made their first investment. I think that's sort of a historical valuation, by the way. I mean, we've seen some activity in the marketplace in terms of acquisitions.
We're going to get to that. We're going to get to that. Yep.
All right. Well, then I won't dwell on that at this stage of the game, Chad. Yeah. But the important part, as we've talked about, is that if you look at the arc of the businesses, Aeroflex is, fairly advanced now. I mean, we've announced the first global prestige beauty brand with Aveda, which is an Estee Lauder brand. Excelsius is mentioned also that it's in many other sectors. But important to recognize here, I'll just go back to Aveda. What's important to recognize about that and packaging in general, but certainly in prestige beauty care, very hard to get the first anchor customer. There's a lot of fast followers. There's a lot of people that want to be first to be second. So penetrating a segment, prestige beauty, you would expect to see then more movement down the line. You expect to see fast followers down the line. But beyond that, Aeroplex has signed purchase orders. They're multi-million unit and multi-year terms across every sector. They're in pet care, baby care, personal care, household, industrial fluids. We haven't made those names public yet, but the commercial traction is real. The agreements are real. The purchase orders are there, and we hope to announce those ones, much as we've announced Aveda, as we move throughout this year. Refinity, again, we mentioned it before. Their duozone reactor pilot results were incredible. They produced their first metric ton of product with yields of 60 to 70%, which is dramatically twice that of competing technologies. They have patent filings in progress. They have, again, a Dow collaboration is a validation point, much like Aveda is a validation point for Aeroflex, much like a JCI and Legrand are validation points for Excelsius. So, and the proposition is very strong. It's not just about economics; it's feedstock hedging. Companies like Dow, BASF, LyondellBasell, they rely on fossil fuel feedstocks. What Refinity is doing is creating an alternative feedstock from mixed plastic waste. That's a feedstock that doesn't exist. That allows chemical companies to reduce their dependence on fossil fuels and hedge against price volatility in that area, which we've certainly seen. So that's durable demand. So these are companies that should not be ignored. Our model is to build industrial giants. All of our companies are expected to become industrial giants. They all have multi-billion-dollar market TAMs.
Well, let's tap into that a second. So, you've mentioned the number for Excelsius, even if it's a historical number. How should listeners think about the total addressable market, the opportunity for both Aeroflex and Refinity?
They both have about the same TAMs. They're both about 400 billion. And this is, again, how you value a business.
Only 400 billion?
400 billion?
Is that what you said?
What did you say, Chad?
Just 400 billion is all?
Just 400 billion? Yeah, I did say 400. Yeah, just 400 billion. Yeah.
Huge.
Well, I will say that, in Aeroflex's case, the TAM keeps building, because when we talk about $400 billion TAM, that's before we even realized there was a market for, industrial fluids, and so that opens up a whole new market. There are other markets we haven't contemplated yet that may open up. I mean, paint is one that we haven't even talked about yet. But my point is, if we're looking at food and beverage, pet care, prestige beauty, personal care, things like that. That's where we talk about 400 billion. And again, with Refinity, when we're talking about 400 billion, you're really looking at the demand by chemical companies for fossil fuels. That's an entire market that we can penetrate with a different feedstock. So these are huge, huge TAMs, and it's important that investors recognize that, because at the end of the day, what investors are trying to do is they're trying to say, well, what's the value of Innventure? And it's pretty straightforward. Innventure's value starts with what's the value of the underlying businesses, and then it's what's the value of the Innventure process on top of that. But you can look at the TAMs of any market. There are many ways to say what's the value of those businesses, but the simplest way often is not in detailed discounted cash flow models that you apply a discount rate to. These are not model-driven valuations. They're generally more heuristic-driven, where you say you're looking at a company and what it's trying to do, and you're saying what's its TAM and what's its penetration rate. What are comparable transactions of similar companies when they do their A rounds or their C rounds? So there's ways in which you can value the other assets. And it's important that investors do that and shareholders do that for all of the businesses, not just Excelsius. In the case of Excelsius, we have the metric of the JCI Legrand valuation. You can look at the Cool IT acquisition or the Boyd acquisitions, kind of 9 times revenue, and you can say, okay, well, you can look at what Excelsius is projecting and say, okay, if they're going to hit their goal by year end, you can apply that valuation metric. And
Yeah.
we've already said that we expect these companies to be at run rates of 100 billion by year end. So investors can make their own assessment of the multiples. But in the case of Refinity and Aeroflex, one simple way to look at these things is to simply say, what penetration rate do we expect, and where are they in their round of investing? So as an example, Aeroflex is in a C round. And you can say, if there's a $400 billion market potential, and they get a 0.25% market share or 1% market share, it gives you a number that you can look at. And then you can say, well, a C round investor is typically going to look for a 3 to 5 times multiple. So divide that number by 4. And you can come up with a valuation number. So I'm not going to do the math because everyone has to make their own assumptions. I'm just giving kind of frameworks that you can look at. Similar with Refinity. Same thing, a 400 billion market cap, what % market share can they get? A round investor is going to look for a higher multiple, probably 8 to 10 times. So divide it by that number, and you can come up with what's the value today of these businesses, or that investors should ascribe to these businesses. And I think it's important that investors do that because we don't just have one asset. We have 3 assets plus an important asset over top of that. The 3 assets are Excelsius, Refinity, Aeroflex, and the other one is the cause of all of those things. What's the value of the process?
Yeah. Yeah. That's so good. And, it's easy to see the, AI data center infrastructure, super sexy right now. Everybody's interested in it. But if you look at that TAM and you compare it to the Aeroflex TAM or the Refinity TAM, they're huge. And I think as people wake up to that, it's not AI, but it's a huge market. So I'm excited to see what happens from that and the development of those. But I do want to go back to the sexy one for now. Bill, let's talk about this. And Roland kind of hit on this a little bit, but I want you to share a little bit about, for those who aren't familiar with the Cool IT acquisition, kind of what does that mean for the market, where it's headed, and then sort of how does Excelsius sit, within that, being that it's 2-phase and 2-phase is becoming the required architecture for data center cooling. Can you just talk about that?
Yeah, sure, Chad. So we've been about just under 4 years in our journey with Excelsius from the start. And when we started, if you kind of look at, and kind of tying back to the addressable market question, when we started, this was before ChatGPT was launched, which was in the fall of 2022. And since that time, the projections for the size of the addressable market for liquid cooling, which I'll come to the distinctions in a moment, but the size of the market opportunity for liquid cooling was meant to grow to something on the order of 5 billion by 2030. Now they're talking about 40 billion by 2033. So there's been a huge amount of leapfrogging in terms of an evolution to liquid cooling, but there's a specific view that ultimately single phase liquid cooling, which I'll come back to the distinction in a moment, is going to not be satisfactory for some of the hotter chips that are coming onto the marketplace. Even if you could make it work with water and all of the challenges associated with it, it's actually more expensive than 2-phase liquid cooling. So Cool IT was acquired, as we saw, or it's in the process of being acquired this year by Ecolab. They got a really high premium for it, but its technology is called single-phase water. And what this is a direct-to-chip architecture where you've got a cold plate that sits on top of your hot processing chip, whether it be a CPU or a GPU, and you pump a liquid through it to dissipate the heat from the chip, and then you condense that fluid or cool it back down and return it back to the chip. So it's a closed loop. Well, in single phase water, there's a linear connection between the amount of heat you need to remove and the velocity of the water traveling through it. So for instance, if you doubled the heat flux on a chip, you have to pump the water twice as fast. So as these chips get hotter and hotter, you've got more and more water flow flowing through these very narrow channels at very high pressures and very high velocities. Well, you can appreciate that the higher the pressure, the more likelihood you'll have of a leak. And when water interacts with electronics, of course, it will destroy the electronics. And right now, a single rack of equipment for these high processing environments, AI workloads, can be as much as $20 million of equipment in one single rack. So a water leak is extremely expensive. So two-phase, which is what Excelsius deploys, uses a working fluid or a refrigerant that you pump through at a much lower pressure point. And the real difference in the science, and this is just fundamental physics, is that when that fluid hits that hot processor, there's a phase change that occurs. It turns into a gas, and the gas can remove literally an order of magnitude more heat than water can under the same circumstances. And you've seen NVIDIA and others talk about the fact that going to two-phase is an inevitable eventuality. Mm-hmm. So the market is headed there. The marketplace for two-phase today is limited to really two people in the marketplace, Excelsius being one, and we enjoy the pole position in our view, and I think that's shared by the rest of the marketplace. So the evolution from air to liquid cooling is the first step, and then going from liquid single-phase water liquid cooling to two-phase is the next big step. Others have already started down that path. We've announced a big partnership with a company called DarkNX, who's dedicating a 300 megawatt data center exclusively to two-phase liquid cooling, and specifically Excelsius' liquid cooling solution. And we're finding the same is true with many of the others. And it looks like the most sophisticated players are the ones that are migrating to two-phase sooner. There have been independent studies that have been done. Jacobs Engineering did one where they compared the economics of single-phase water to two-phase liquid cooling and found that it's about 12% cheaper to deploy a two-phase solution than it is a single-phase water solution, and the CapEx is comparable. So when you think about it in those terms, it's not only a required solution down the road, it's a better solution today.
That's great. Yeah, that makes a lot of sense. Let's shift gears a little bit. I want to move back to talking a little bit about the Innventure shift and sort of what management's doing that might be a little bit different than in the past. Roland, I know that dilution used to be a central concern with investors. The funding architecture has clearly shifted. And you addressed this earlier, and I don't know if you want to add anything to this, go into more detail, but do you want to walk listeners through how the operating companies are being funded today and why that's structurally different and why that matters?
Sure, Chad. I think it's important, and as I said, we didn't talk about it before, but you can always hit on things 3 times to make a point.
Yeah.
One of the big shifts that has happened is that we have hit inflection points in all of our businesses. Excelsius is now self-funding because it's fully funded, in our opinion. And the other businesses, Aeroflex and Refinity, have hit commercial and technical inflection points that allow them to raise capital on their balance sheets. I think to frame where I'm going to take this conversation, it's important to understand that any growing company, any company that is not yet cash flow positive, that is growing and needs to fund that growth, is going to have dilution. It's an axiomatic fact. Growing companies need capital to fund that growth. What you have to do, and this is true with all companies that do well, is that the value they create grows faster than the capital they take in to fund that growth.
Sure.
So
Yep.
that's important to understand. On the other side of that, you expect the opposite. You expect to generate so much excess cash flow that you can make distributions to your shareholders, but you have to get there. And you take dilution in different places. So today, what we've realized, and our investors have realized it, and they've talked to us, but we share the same opinion. We're moving in this direction in any event, is that we know, in our opinion at least, we believe very strongly that we have a bird in hand with Excelsius. So we're not getting the value recognition of that and our companies on our balance sheet. So it's very expensive capital to raise money at Innventure to fund the other businesses. We do, because what it does is it creates permanent dilution, and it creates dilution to the Excelsius story. It makes more sense to take the dilution in the form of raising capital on the balance sheets of our companies and slightly reducing our ownership as a result. But because we can get proper value for those businesses on their own balance sheet. I could look back the other way. It would not have made sense for us to raise $65 million on Innventure's balance sheet to fund Excelsius. We got more value for Excelsius by getting a pre-money valuation of $600 million and raising the capital there strategically. So I think that's important. But the important part here is that we are not raising that capital for Aeroflex or Refinity on Innventure's balance sheet. We're raising it using the same playbook that we've used for PureCycle and Excelsius and for Aeroflex in its earlier rounds at the operating company level. So when you do that and you increase your G&A materially, as Bill mentioned, about 61%, it's not that you're going to have no dilution. It just means that the dilution or anything that's needed to fund Topco until we become evergreen is not going to be a big number. You can't extrapolate last year's number to this year. That's a nonsensical extrapolation. But investors often do that. They extrapolate the present indefinitely, whether it's good or bad.
Yeah.
So when things are going well, we don't mind them extrapolating indefinitely. But our the capital needs at Topco are much less going forward.
Hey, Roland, that's a really good point. Can you talk a little bit about how Innventure returns value to its shareholders? How do we think about that?
Sure, Chad. I mean, that's a great follow on. At the end of the day, the whole story is about growing the business and then returning the value to shareholders. So, how does Innventure create value for its shareholders? The primary way in which we do it is, as we said in the beginning, we are an industrial conglomerate of the companies we create. So the primary way in which we create value is by consolidating the financials of the companies we create. And as they go through their S-curve of growth, our objective is to create a high earnings per share growth stream, and we compound that with each new company launch. If you have companies that all have successive S-curves of growth and you stack them upon each other, you get a high and compounding earnings per share growth story. That's the primary way in which we intend to create value, is by creating that earnings per share growth trajectory and letting the market value it. And hopefully the market would value it at a premium, which it does in the case of other successful conglomerates. Beyond that, though, and there are natural points for any company where we might monetize that company, either through taking the company public or through a trade sale. Those are done on a case-by-case basis, and in fact, PureCycle was the first one on a case-by-case basis. In the case of PureCycle, it was very natural for us to conclude that PureCycle should be a public company. It had a huge growth model in front of it, but each plant is very expensive to build. It needed its own currency. It needed to be a standalone public company able to attract capital in order to execute its growth story. So for us, and that was kind of beyond the scale of us doing it as the parent of it. And it made more sense for us to recognize the value of PureCycle, allow it to be a standalone company, and use its stock as currency to execute its business model, which is what we did. So we took PureCycle public in 2021. After starting in 2015, we took it public at about a $1.2 billion valuation. We distributed out the majority of Innventure's pro rata interest to our shareholders. Did not keep it, did not hoard it. We distributed out over $460 million in gains in the form of pure cycle shares to our shareholders. And I think that was something, it was an over 20x MOIC or return to our shareholders that put money in, which is a staggering number. So, I mean, obviously there's a treasury management function. You keep enough on hand to fund your own business for a reasonable period of time, 2 or 3 years. But what you don't need beyond that, you distribute out to shareholders. And that's not just from when you have if you take a company public or you sell it. If our cash flow from operations generates huge surpluses, we would expect to distribute those out as well once we get to that point.
What's crazy about that is you still get to keep your shares.
Yes, that's the whole point. That's the whole point of us going public. You keep your shares. The value of your shares can increase if we can demonstrate high earnings per share growth. And if we have high cash flow, you get special distributions.
Yeah. Bill, anything you want to tack onto that?
No, I think you've captured it pretty cleanly, both you and Roland, on that topic.
So how should investors, when you're thinking about Innventure, the mental model they create, is it like biotech? You got the high capital intensity, you've got, multiple assets, different stages. Is that how they should view this?
No, absolutely not, Chad. That's the whole point. Companies let me just frame it. The similarity you're building, clearly Innventure is not a biotech company. We all know that. But what you're saying is that there are structural similarities between biotech companies. And you could argue that there are structural similarities between any company that's exploratory. Mining exploration companies are the same. Public venture studios where you have lots of minority interests in businesses but no control or no ability to upstream cash flows. Those businesses are all valued at a discount, and they're valued at a discount because what investors see is perpetual high OPEX needs, perpetual dilution to fund those OPEX needs, and occasional asymmetric payoffs. You're either going to have a winning drug or you're not. You're either going to discover minerals or not. That is not the Innventure model. The Innventure model is that of an operating conglomerate of the industrial giants that it creates. And by definition, as those businesses grow and produce cash flow and excess cash flow, they flow through to Innventure. Innventure becomes cash flow positive on a consolidated basis. So companies that do that, if you look at conglomerates out there, Brookfield, Danaher, even Roper, although Roper has had some concerns recently because everyone's worried about software and the impact of AI on software. Mm-hmm. But generally speaking, where I was going is good conglomerates that build strong operating companies underneath trade at premium valuations typically. And that's, and we're trading at a discount. So yes, we're being measured like a biotech, but that's the incorrect narrative that we've begun changing in the marketplace. We're building industrial giants, and as we show proof points, we think that our valuation should change from that of being a discount to being a premium. But we have to demonstrate that we're executing in order to be warranted that premium valuation.
Yeah. Following those lines, and Bill, you can chime in on this too. Innventure went public. Before that, there was a lot of interest in it going public. Some people have noticed, I think, a shift in the shareholder base, and that's probably shifted since a lot of people that invested in Innventure early on, or maybe moved on. There's other investors that are new. I'm curious, and I think others would be curious too. What's the institutional participation look like? Is it shifting? Are we getting more engagement from the institutional side? And then maybe Bill, you could speak to this too, but what does that signal for the company and basically where we're headed?
Chad, why don't I jump in and take that to start with, and then Bill can fill in the back end. I'm the one that talks to the investors mostly, but Q4 we added 64 new institutional positions. So we went from 40 to 101 institutional holders. They hold, as of the end of Q4, about 30% of the float. Now, 50% of those institutional investors are long-only managers. About 23% are family offices and trusts. 22% are hedge funds, and then we have a few pension funds rounding out the balance. When we did the registered direct offering in January with Titan, those were all institutional investors. So all of that capital raised, 40 million, was institutional investors. So I would say that what you're seeing, and this is very typical in the early stages of a business, is you see a turnover of the float. You see a lot of the early investors that have had gains that want to get out. They've kind of become short-term holders because they were there in the beginning, and now you're getting the big institutions that are going to want to hold it for the next stage of the business. So you're seeing a turnover in the float, and that's reflective of what you're seeing in the stock price. I mean, the stock price has been range bound for a while. Every time it trends down, you see these institutions come in, they see a great deal. And then you run up. Anyone that wants to get out is going to take advantage of that, and then so you kind of get that consolidation and base building. Once you turn over a float, though, the possibility in front of you is that as you hit KPIs and you no longer have the overhang of people that want out, and you have a bunch of shareholders that are waiting for what's next, you kind of can break out to the upside and recognize that value. So, Bill, I don't know if you want to add to that in any way, shape, or form.
Yeah, I would just say that we're finding more and more, I would say, shareholders that are long on Innventure, right, as opposed to transactional. Mm-hmm. Ultimately, as they see progress, they see that our risk profile is quite different than biotech, going back to your prior comment. Our probability of success is much higher. Now, we only have 4 examples so far, but we have pretty good evidence that all 4, at least at the moment, look like they're on the trajectory for success. But I think as we put more companies out there and people see the success profile of those companies and the addressable markets and the resultant size of those opportunities, we're starting to see a trend, I think, toward more and more people that are going long on Innventure.
That's good. And Bill, I want to follow up on that a little bit. You mentioned progress, being measured, as Innventure and the opcos move from this idea of potential, and we're really starting to execute, and there's performance, and we can start measuring those. What are some of the key milestones we can be looking for as this whole Innventure story continues to unfold?
Yeah, sure. Well, in terms of just timing, I mean, next week at Data Center World, Excelsius is presenting jointly with JCI and Legrand, and really it's partnering for scale, I would say, is the theme for that. And so what you're seeing is a way for each of Johnson Controls and Legrand to expand their footprint, if you want to think about it in those terms, in the data center by partnering with Excelsius for more comprehensive solutions. On the 27th of April, we have an investor day where we're having each of our 3 company CEOs present their own businesses so people can get an understanding of what the commercial traction and progress is in those businesses. And there'll be a bit of a Q&A at the end of that. We've targeted Excelsius to be cash flow positive by year end. So as we get toward the end of 2026, we can certainly measure how we're doing against that goal that was stated. And similarly, Innventure itself is projected to be cash generative in 2028, but we'll see an evolution toward that. We talked about Aeroflex and the Aveda relationship. There are already, by the way, a few early purchase orders from Aveda. So while they expressed a more larger scale rollout in 2027, we've started down that path with Aveda. Affinity is designing its first large-scale plant, a 10 kiloton plant, and so you will see both site selection and engineering designs for those with estimates of capex and so forth. So there are a lot of things that are happening, and then we have at the middle of May we'll have our first quarter earnings call, and we'll provide any updates that are relevant at that point.
That's awesome. That's great. Exciting stuff ahead. All right. Roland, Bill, thanks so much for this. Roland, last thoughts, anything you want to leave people with?
Yeah, I'm very appreciative of our shareholders. I'm appreciative of our investors. They've been patient in the first year. Again, first year of going public is the toughest year. You've got the high cost of going public. We were funding all of our businesses. But I just go back to that inflection point we've been talking about. We are at a real inflection point or tipping point in the business where we think we can demonstrate real value growth in all of our businesses. And I mean, from an investor standpoint, these are good things. They line up with everything we talked about: turning over the float of the business, getting a new shareholder base, fresh shareholder base, shelf eligible company, inflection point. Yeah. I couldn't be more optimistic.
Great. Bill, final word.
Yeah, sure. So my view, and the thing I would want to impart at the end, is that we're in the first quarter of our game here. And while we've created 4 companies that are very exciting, this is really the engine that can create more Excelsiuses, more Refinities, more Aeroflexes, more Pure Cycles. And we've been doing this, for quite a long time, and we believe that we can continue to do that. And what we want to do is bring the shareholders along with that same level of belief, and we do that by putting more and more points on the board.
Yeah. We've moved from theoretical to empirical. This is no longer about potential and what we think is going to happen. Things are happening. We're firing on all cylinders, which is super exciting. I just want to thank everyone for listening. Remember, if you want to hear directly from our CEOs, we'll be having a call April 27th at 5 p.m. Eastern. You can sign on and register for that at ir.innventure.com. Roland, Bill, thanks so much. Appreciate the time and look forward to talking again soon.
Great. Thanks, Chad.
Thanks, Chad.
Hey, if you have questions for us at Innventure, just feel free to reach out to us at letstalk@innventure.com, or you can just find us on our website at innventure.com. That's 2 N's, INNVENTURE.com. Thanks.